us, everyone who is here in the school and everyone who is joining us online. My name is Fatima Iqbal. I'm with Azzad Asset Management. I'm an investment advisor. And inshallah, today we're going to be talking about halal investing for education and retirement. So first off, we're just going to go through some basics on investing. And hopefully this will give you an idea of where to start before we actually get into some of the more details of actual college planning. So before you start investing, what are some things that you really need to think about? One of them, of course, is organizing your finances. And what does that mean? Really, that simply means understanding where your money is coming in and how it's going out. That's going to be important to understand because there may be some opportunities there when it comes to maybe there's some extra money that you actually can invest that you didn't think you had. Secondly, paying off debts. Being able to reduce the amount of debt that you have is always important, actually, even before you start thinking about investing. So a lot of people, think, should I, first think about investing? I have a lot of goals coming up, or should I consider, maybe the debts that I have that are outstanding? And one of the interesting things about debt is to remember, any debt that you're paying where you have, either a profit amount or an interest amount you're paying, you can consider that as a negative rate of return that you're earning. So if you're looking to invest with a positive rate of return, remember that your debts are actually a negative rate of return for you. And third, it's important to have an emergency fund. And what that means is it's important to have maybe 3 to 6 months of expenses saved up so that whenever you do start investing, if something happens and you need money, you don't have to tap into those savings in order to, deal with an emergency. Your strategy can stay in place, and you don't have to dip into long-term funds for that emergency. So what really is investing? When we talk about investing, we're talking about saving versus investing. And what saving is just a process of setting aside money, right? You decide this is how much I'm going to save. I'm not going to use it. I'm not going to spend it. What investing means, that's the process of what you're going to do with those savings. How are you looking for the money that you've saved to actually start growing? And why is it important to invest? Why is it not enough just to set money aside and leave it maybe in a checking account? Why is it important that you find ways for that money to grow? Well, the future, of course, is unknown. There's increasing education expenses, which I'll talk about. The cost of college is actually increasing every year. We're seeing longer life expectancies. So when it comes to retirement, the dollar that you put away now, you'll probably need more than that, in the future to account for inflation. When we think about college education and retirement, often we're thinking, well, what about financial aid? That will always be there. But financial aid consists of interest-based loans. So that may be one thing that you and your family are trying to avoid. And when it comes to retirement, Social Security and employer pensions are no longer the norm. These are things that may no longer be guaranteed, so it's important to be saving yourself and trying to at least grow that money. So this is just some basics. For anyone here, has anyone invested before? Any investments? Okay. So just a little, primer on investing and understanding some of these terms that we'll be talking about. Stocks, bonds, and mutual funds. So what are stocks? We've been hearing, maybe if you've been listening to the news, about stock prices going up and down. Recently, they've been, a lot of them have been going down. But what stocks really are, these are shares of publicly traded companies. So these are ownership that you have in a company, and it's part of the equity market. On the other hand, bonds are part of the fixed income market. These are typically debt, and they're typically interest-based. So what a bond really is a lending-borrowing agreement. A company has borrowed money from you, and now they're paying you back with an interest stream. And there are now, alhamdulillah, Islamic alternatives to fixed income and conventional bonds that include Islamic bank deposits and sukuk. And I'll talk about some of the options that you have to invest in halal fixed income. Now, what are mutual funds? What mutual funds are, these are really a basket of securities, a basket of either stocks or bonds that you can invest in. These are baskets that are professionally managed by managers. So this allows you to have access to investments without having to pick and choose each individual one. The basket typically is diversified. They'll have exposure to different industries. And most of all, it has a professional fund manager. So somebody who's really understanding what these companies are doing, deciding which companies should be in the portfolio and which ones should not be, which ones should be bought and which ones should be sold at different times. So any questions here on what is a stock, bond, or mutual fund? All right. If anyone online has any questions, feel free to put that in the chat box, and I'll try to keep an eye on that so we can address any of those. So understanding the impact of time. Now, I mentioned before that if you want to save $1 now, you will likely need more than that dollar in the future. If you think about something simple like a gallon of milk, if you're buying a gallon of milk, maybe at $2.50, $3. In 10 years, how much is that gallon of milk going to be? So if you save that $3 now, it may not still buy you a gallon of milk, down the road. Now, what if you start saving that money? And that's where this graph comes into play. So in this graph, we are assuming that we're investing $3,000 at the end of each year, and we're getting a 6% rate of return. And the graph is taking a look at different times when we start investing. So if we start investing, let's say at age 20, again, just $3,000 at the end of each year with a 6% rate of return, by the age of 65, that money is about $680,000. Now, if we wait and we say, well, at age 20, it's difficult to put aside, $3,000, that's understandable, and we wait, and start investing at age 35, by age 65, now you've only saved about $254,000. And again, if you put it off another until age 45, then you've only saved about $120,000 by again the age of 65. So it's important to start investing, even if it's a small amount, earlier than later. And in this example, actually, you can see how setting aside even something like $100 a month, how that can grow over 5 years, 10 years, 15 years, and 20 years. So again, this is an example with a 6% rate of return. And seeing that $100 per month being invested, in 20 years that can grow to about $46,000. So remember when I was saying understand your expenses? Maybe you can figure out a way to save $100. Maybe there's an inefficient way that you're spending that $100 now, and instead you clean up your budget and you say, well, now I'm going to invest it instead. And over 20 years, you can see that really can accumulate and be really of great benefit. Now, this graph, what this is showing us risk versus return. So we talked a little bit about what is a stock, what is a bond. Now, any kind of investment is going to have some type of risk. That means there's some downside that you will have to take for the potential for that investment to give you a return. Now, how much risk should you take and how much return will it give you? This is giving you this is basically plotting how different investments are when it comes to risk and return. So if you can see, in the bottom left, you see Treasury bills. Now, on the bottom, on the horizontal axis, you see this is a measurement of risk. And on the vertical axis is the measurement of return. So Treasury bills, you see, have the least level of risk, but they also have the least level of return. And that's because Treasury bills are guaranteed by the government. These are government bonds. Now, as we go into higher amounts of risk, you start seeing now there's intermediate-term government bonds, long-term government bonds. Then you see the light blue dot, which is for large stocks. In large stocks, you see that the risk is higher, but also the return is higher. And in the top right, you see that small stocks, actually, these are stocks of small-sized companies, actually carry even greater risk, but they have greater potential for return. So the idea that there's always a balance between risk and return whenever you're putting a portfolio together. Now, how much risk should you take? A lot of clients always, ask me, well, depending on the market, what should I do? The market is really something that really should not be a focus whenever you're creating your investment plan. What should be your focus is the amount of risk that you're willing to take and your time horizon, meaning how much time you have until you're actually going to need the money. So what you need to see is, are you in a phase right now where you have a lot of time until you need the money? If so, that's great, because you don't need the money now. You can actually invest it. You can take more risk for the potential of more return. Now, if you don't have that time, or if you're very uncomfortable with risk, you would lose sleep, let's say, with your investment dropping. You need to consider whether you should be investing then. And then also important to understand is not just how much risk you're willing to take, but also how much risk you need to take. Because if you have a long term, yes, you may feel uncomfortable with losing money. Who doesn't? You know, no one likes to see their investment account go down. But whenever you're looking for a long-term goal, it's also important to understand how much return do you need. Well, if I'm going to send my kid to college in 10 years, you know, I need this amount of money that I can save to grow at least hopefully this much. In order for it to grow this much, I need to take more risk. So that way you can justify how much risk you're taking for the level of return that you need. So as you can see, when you're further away from your goal, then you can take more risk. As you get closer, like in this example for retirement, as you get closer to your late retirement years, your risk appetite decreases. That's not the time to be taking risk because you're going to need to use your money soon, and you don't want it to be fluctuating according to the market at that time. And investing requires patience. Now, this is, again, something that's not always easy to do, but this is just showing you some data to take a look and see how one-year returns for the Dow Jones Industrial Average did compared to 5-year returns for the same index, which is the Dow Jones Industrial Average. And this is between a long time span, you know, between like 1928 and 2007, and then 1932 and 2007 for the bottom graph. So in the top graph, you see that all of these red bars, these are when returns were negative. So you can see that in the one-year time periods, there's a lot of negative, much more negative bars. You see that there was negative rates of return. Now, if we look at the 5-year returns, there's significantly less negative bars. Now we're starting to, and also the positive bars are higher. So this is just showing you historically, those who are patient, you know, their 5-year returns were much better than those who are just taking 1-year returns. And the impact of market timing. So I put this slide in here because, again, with what's happening in the market, a lot of people are getting uncomfortable. You know, the market is fluctuating a lot, you know, sometimes dropping 2-3% in one day. So what does that mean for the investor? Does that mean you should panic and you should say, I can't take this? This is too much fluctuation for me, even though you may have a long time before your investment goal? When you take a look at this historical data, we are looking at investments starting from 1980 to 2012. And we're taking a look that if there was $10,000 invested, what happened whenever you missed some of the best days in the market? What the best days means is when the markets really jumped suddenly. And what you see here is that even if you miss some of the best days, you miss just the best 5 days, your investment can drop from compared to if you were invested the whole time. So if you stayed invested that whole time period, your money would have actually grown to about $332,502. If you missed the best 5 days, it would be only $215,000. And you can see that if you missed almost the best 50 days, it would have been only about $30,000. So it's really not about timing the market. It's about being in the market. You have to actually be in the market to be able to benefit from those jumps that are there. And not worry about when the market is fluctuating. A few smart tips for investing. One, of course, getting in the habit of saving. Saving is not something very exciting. It's actually quite boring. It's about being strategic, about setting a plan and sticking to it, whether it's $50 a month or $100 a month, but it's getting in the habit of doing that. Also investing your money so it keeps pace with the inflation over time. Again, you want to make sure the money that you're saving, you're actually going to be able to use later in life or whenever you need it because it's continued to grow with inflation. Staying away from putting all your eggs in one basket, again, diversifying so that you don't have everything invested maybe in one company stock. You want to spread out over different industries, in different asset classes. So that can help you. If one of them, maybe if one company is not doing so well or one industry is not doing so well, all your money is not there. It's spread in different areas. Also focusing on long-term potential rather than short-term price fluctuation, asking questions and becoming educated. So always try to understand your investments. I would never recommend an investment that you don't understand, no matter how good it might look. And invest with your head, not your stomach or your heart. And that comes back to being able to focus on your investment goals rather than worrying about what the market is doing. I would say the most mistakes investors make is whenever they make decisions because of market timing. They're trying to play the market versus trying to focus on their investment goals. So with that kind of primer on investing, I want to talk a little bit more about college planning in particular. So when we talk about college planning, there's a lot of things competing for that goal. You know, you have maybe a house payment going on, car payments, you want to still provide for vacations and enjoy the current time that you have with your kids. You hopefully or maybe are trying to do something for your retirement, and then you have these little guys who are probably going to cost a lot once they're 18. So how do you balance all of these goals? So this is just to give you an idea of what the cost of college is now. If you take a look here, the cost of college at a 4-year public institution this year was about $24,000. At a private institution for 4 years is about $47,000. So this is including the fees, the room and board, the books, the transportation, and also personal expenses. So typically what you could expect if your kid was going to college this year. And this is the future cost of college. So we talked about inflation, how a gallon of milk gets more expensive. Well, a credit of tuition gets more expensive too, and actually it grows about 5% per year. So the effect of inflation on college has actually been much more than what general inflation we've seen. So when we take a look at the potential future costs, we can see that in about 10 years, a 4-year public university can cost almost $40,000. And a 4-year private university can almost cost, over $75,000. So it's a significant amount of money, just to get a 4-year education. So financial aid. This is one of the questions a lot of parents have. They say, well, when my kids go to school, college, financial aid will hopefully be there. So how is financial need determined, and what does it include? Interestingly, for those who haven't gone through the process of getting financial aid before, financial aid typically consists of 4 types of income. One is from loans, from grants and scholarships, and then from work-study jobs. So loans, again, have to be repaid. Grants and scholarships typically do not have to be repaid. Those are given to the student either based on their financial need or their merit. And work-study jobs also have to be repaid in the sense that the child has to work at the college doing different jobs. And how is this need determined? So what happens is there's a form, typically the FAFSA is what is a lot of universities use. And so they take a look and they see what are the income of the family, what are their assets, really what do they have. And they plug that into a formula, which is either they use a federal or an institutional methodology, and they come up with a family contribution. The expected family contribution is the number that they say you will have to contribute for your child's education. And whatever is left, that is what the financial need is. Now, again, it's important not to rely too heavily on financial aid. Of course, one of the most important reasons, I think, especially for Muslims, is that student loans typically make up the largest percentage of the typical aid package. So these are going to be interest-based loans that either you or your child are going to have to repay. So whatever you can save now and help in avoiding taking those loans, the better. And a rule of thumb on the potential percentage of expenses that are covered, typically loans, like I said, make up the majority of those financial aid packages, typically up to 50%. Grants and scholarships may take anywhere between 0 to 15% of that package. And then again, work-study jobs can vary. So again, don't rely necessarily on that financial aid because what it's composed of may not look so attractive once it comes to you. Now, when I mentioned that there's a formula that they use in terms of determining how much you can contribute, and they take a look at what your income and your assets are, they're going to take a look and see what are assets that the parent has and what are assets that the child has. And this is going to be important whenever I talk about a few of the different college saving tools that you can use. So if it's considered a parent's asset, it's considered 5.6% of the total assets. So for example, if there was $10,000 in a savings account, the formula would determine that about $560 could be the expected contribution. They understand you have other expenses that you have to deal with. You can't put all of it into your child's education. So about $560 would be the expected contribution from that savings amount. Now, if it's considered a child's asset, then 20% of the asset is considered. So again, that $10,000 in savings, about $2,000 would be considered the expected contribution. So it's important to keep in mind as you're saving, what are considered parent assets and what are considered child assets, because if you do apply for financial aid, then this will be important. Now, these are the typical college saving options. Probably you've heard of some of them before. They're what are called 529 plans. These are typically offered by states. There's a Coverdell Education Savings Account. There are U.S. savings bonds. There are UGMA or UTMA custodial accounts. And finally, there are mutual funds and stocks that you can invest in, either as a family, you can own them individually, or you can own them jointly. But those are basically investments that are not necessarily for college, but you can use them to save for that. Now, of these options, which one is right for you? So I'm going to go through a few of these, and then we'll focus on the ones I think that will be of most importance. When it comes to the 529 plans, like I said, these are typically offered by states. Now, what that means is they have good tax benefits. The money grows tax-free. So when you put the money in, you don't get a deduction, but the money grows tax-free. And when you use it for educational expenses, you don't pay taxes on it. So that's a nice benefit. There is a penalty, however, if you use it for something other than qualified education expenses. And finally, it's considered a parent asset when you do apply for financial aid. So if you are using the 529 plan, whenever you list it, it's going to be considered a parent asset, so it doesn't, I would say, hurt you as much on the financial aid application. And finally, there are two types of 529 plans. One is the prepaid tuition plans, and there are also investment plans. So again, these are plans that are offered by the state. Prepaid tuition plans basically means that you can buy credits right now at today's cost for your child to use in future years. That is okay from a halal investment perspective. The other type of 529 plan is the investment choices that you have, and unfortunately there's no 529 plans that offer halal investments when it comes to the 529 investment options. Now the next type of account is a Coverdell Education Savings Account. This also has the tax-free benefits, so earnings grow tax-free just like the 529 plan. Same thing, they have a penalty if you use it for something other than education. And also it's considered a parent asset for financial aid. The additional benefit that this investment option has is that you can also have full control of the investment. So you actually are not limited by the state in terms of which choices you can invest in, but you can go and invest in any way you like in any investment option. So you can definitely go and pick halal mutual funds, for example. The downside is that this has a lower contribution limit and it has eligibility restrictions. What the contribution limit is $2,000 per year. So you can only put in $2,000 per child per year into a Coverdell account. And also in terms of eligibility, if you're making more than $190,000 per year, you can't contribute to the Coverdell either. So those are the drawbacks of that. The U.S. savings bond. Again, it gives you, it does have the tax-free earnings. It is considered a parental asset. You do have investment control. However, there are no halal savings bonds that you can invest in. So again, another major drawback here. Custodial accounts, again, give you full investment control. However, they do have some tax implications, and also they are considered a child's asset for financial aid. So it can hurt you from a financial aid perspective. The best, I would say, quality of the custodial accounts is that you can use this for any purpose that is for the benefit of that child. Now, a lot of parents, they're saving for their children, and they wonder, well, what if my child goes to school and they get a full ride, or alhamdulillah, I'm still working and I can afford to pay for my child's education out of pocket. The good thing with custodial accounts is that money can be used for other expenses, helping them buy a car, helping them maybe with marriage expenses later on. It can be used for anything that is for the benefit of that child that is not considered a parental responsibility. So you can't go back and dip into it to pay the mortgage, and you can't dip into it for your own personal expenses. But it's a good account to have, again, as a safety net for your child. God forbid something happens to you, money needs to be used for them, so that can be available. And finally, mutual funds and stocks that you can own in an individual or a joint account in your own name. Again, it's considered the parental asset. You can use it however you like, even if it's for yourself if you need. It doesn't have the tax-free benefits, but you gain the full investment control. And again, you can invest it according to a halal way. So you may be interested in opening a Coverdell account if you have less than $2,000 to invest in a year, or if that's the max that you want to do per child. You want to have complete investment control. If you want to use the money for elementary or secondary school education, and you meet the income limits. So again, you're making less than $190,000, and you want the tax-deferred growth. Then the Coverdell is a very good option. And even if you are making more than $190,000, the rule is that the depositor cannot be making more than $190,000. So if you have a family member or a friend who would like to open a Coverdell account for your child, they can definitely do so. Now, the other option, the UTMA and the UGMA custodial accounts, again, these provide some opportunity for tax savings, although not as good as the Coverdell or the 529 plan. You typically manage the account yourself, so you can choose halal investment options is one of the great benefits. However, again, the downside is that the asset is held in the child's name, so you can use it to pay for college, but again, it may hurt you when it comes to the financial aid application. You have complete investment control. Gifts are irrevocable, so like I said, you can't take the money back to pay for your mortgage. Once you make that gift to your child, it has to be used for the benefit of that child. And custodianship ends and the child gains control at the ages of 18 or 21. This is a requirement by law that once the child is of age of majority, that's when they have access to the accounts. Although I would say, in practical life, most clients or most investors are not necessarily telling their kids that they have these accounts. They're not necessarily giving them the full control until they feel that they're mature enough to use them or they've been used for them. And in terms of the taxation of these, now the taxation means that this money is not going completely tax deferred. So when there are gains in the account, they are going to be taxable. However, the first $1,050 is tax exempt for the child. Any income that is earned between roughly $1,000 and $2,000 is taxed at the child's rate. And when the investment is generating more than $2,100, that gain is taxed at the parent's rate, even if it is a higher tax bracket. So something just to keep in mind. Now, I wanted to bring this slide as well, which is talking about Roth IRAs. It's not a conventional way to save for for college education, but a lot of people talk about this, so it's important to be aware of it, and it is a tool that you can use. So what a Roth IRA is, it's an individual retirement account. So it's specifically supposed to be for retirement. What a Roth IRA means is that this is an IRA that is post-tax, meaning you've already paid the taxes on it. You don't get a tax deduction. But when you pull the money out for retirement, you don't pay taxes at that time. Now, the way people use Roth IRAs for college savings is there's a clause basically that says a Roth IRA, for an education, a Roth IRA can be used without a premature penalty. So if you for education expenses, you don't have to pay a 10% penalty. If you're taking it out for other reasons, you would have to. So although it's a retirement savings vehicle, it can be used for qualified education expenses. Retirement accounts are not counted as an asset in federal or college financial aid formulas, so it's a benefit to have them. And again, although it's for retirement, it can be a safety net for your college expenses. So I wanted to mention that as another strategy. If you have a Roth IRA, if you're thinking about having a Roth IRA, that can be an advantage. And just to bear though, you will have to pay some taxes on any gains. So if there's been gains in the account, you would have to pay taxes on those. Now, saving for college and retirement. A lot of people say, well, what should I do? Should I save for college or should I save for retirement? Really, it is a balancing act, but I would say that if you're looking at both of these options or both of these goals, you really should save for retirement now, simply because there is no financial aid application when you are retired. There's no safety net. There is Social Security, maybe your pensions, but really, it's not the same as when you're in college. Additionally, you would miss out on years of tax-deferred growth, and it's harder to catch up later. So that slide that I showed you before, that it's better to start earlier investing for your retirement, it's the same. The earlier you could start, the better. The later you start, it's harder to catch up. So whenever you have to, it's better to err on the side of saving for retirement. And finally, just dip into your retirement accounts as a last resort. It's an option that you have to use them for education expenses, but definitely try to save for your retirement, and and do college savings as well. If you have to dip into the retirement, you do, but just remember that again, you're not going to have that amount once you're retired, and it's hard to make up for that lost time. So next, I just want to briefly kind of go over what is halal investing. I talked about some of the types of college planning that you can do and invest in a halal way. So what are your real choices when it comes down to it? Say I've opened up a Coverdell account now. Now what? Now what can I invest in? So when you invest halal, what does that mean? It basically means investing your money in a way that is going to generate a return that is halal. It's not, if you, for example, if you want to make money, you're likely not going to go try and buy a liquor store and sell alcohol and say, well, this is the revenue I made. Similarly, whenever you're investing, you don't want to go and buy a company that manufactures alcohol and generates its revenue from alcohol and make money that way. So when we take a look at halal investing, we're trying to avoid, investments that are going to generate revenue from things like alcohol, gambling, pork, tobacco, interest, and also we're wanting to make sure that these are sustainable companies. These are companies that have low debt, and that really we're making an investment. We're not doing speculation here. So in the halal investment process, it's important to screen all the companies that you're looking to invest in to make sure that those companies are generating halal lines of business and halal revenue. And it's important that even after you invest in them, that you continue to monitor them, because companies are dynamic. A company may, 1 month have low debt, another month they take on more debt, and now, it's considered more of a debt asset than an equity asset, and it would not be permitted to invest in it anymore. Or they may add on a subline of business. They may add on a credit card wing to their their financial wing, and no longer again pass these halal investment guidelines. So it's important to monitor them, and then also it's important to purify. And what purification means, it means getting rid of even any insignificant amount of money that you never intended to benefit from that may have come from a haram source. So to explain to you what that means, whenever we're investing, we have to take a look at all the companies that are out there. And companies are only required to report when they have a certain line of business when it's more than 5% of their revenue. What about when it's less than 5%? So let's say, for example, what about those airlines that are out there? We know they're selling alcohol in their flights, but they're likely not listing the sale of alcohol as one of the, especially if it's less than 5% of their revenue. So at Azzad, what we do is we understand our intention, and the investors in lines of business intention was never to benefit even from an insignificant amount, even if it was 0.5%. But there's an unknown factor here. We don't know exactly how much it is because the company is not required to report it. So what the purification does, this assumes that up to 5% of revenue may have come from an impure source. And we do the purification calculation, and the calculator is on our website. So you basically enter the number of shares you own in the mutual fund, and it will tell you what the purification is. And the purification is the amount that, again, you never intended to benefit from, and you give it back to charity. This is not sadaqah, this is not zakah. This is really to cleanse because you never intended to benefit from it in the first place. So the purification is a very important part of making a halal investment, because again, the idea is that we don't even want to take an insignificant amount of revenue from an area that we're trying to avoid. Now, the Azzad methodology, so what we do when we're looking at our socially responsible halal lines of business, what we're doing is we're screening companies, again, that have lines of business in certain areas, like, again, tobacco, alcohol, weapon industries, pornography, pork, financial services, and, again, companies that invest in all of these areas. We're also taking a look at companies that have excessive debt and avoiding them, avoiding companies that have excessive receivables, and companies that have excessive cash and equivalents. because like I said, what we're doing is we're really wanting to make an investment in the company and what they do, their products and services. We're not investing in the debt that they have on their balance sheet. We're not investing in the excess cash that they have. We don't want to be trading money for money. So even though a company may have excessive cash on its balance sheets, we want to invest in actually what is it doing. We're not wanting to trade, the cash value of that stock. And finally, there's additional features that we look at, which again are socially responsible. So we try to pick companies that have shown good environmental performance, good in areas of human rights, labor relations, and anti-corruption. So at Azzad, we really feel it's important to be genuine in terms of creating an investment solution that follows these guidelines. For us, halal investing is not just a label. It's really an important part of the whole investment process. And we've actually found that when we talk to our portfolio managers, who again are managing sometimes assets that are not invested in a halal way, even they understand the value in this. So alhamdulillah, Islamic finance really has a lot of value, not just from the aspect of we're trying to invest in things that are good and that help people and do not harm people, but it makes a lot of financial sense. Avoiding the companies that have high debt. That's a lesson that we learned in the 2008 crisis, what debt can do to an economy. So these are really important principles, and the principles where we base these off of is from AOFI. So no longer is industry saying, okay, who is your scholar, who is your imam, who is giving you a fatwa. It's based off of AOFI. And AOFI, if you haven't heard of them before, it's the Accounting and Auditing Organization for Islamic Financial Institutions. And they have a board of about 20 specialized scholars, some of the most well-noted scholars around the world from various different countries. And again, covers all the schools of thought. So this is a consensus that these scholars have come together. So it's no longer about, this is, Hanafi, Maliki, etc. It's really a consensus that all these scholars have come together when it comes to Islamic finance. And they've issued standards. And these Islamic finance standards are what are being followed now. Internally, we have a few ways where we've integrated these, the AOFI guidelines. Internally, we have a certified Sharia auditor and advisor, Mashar Qasim. He's our president and CEO, and he's been certified by AOFI. He was the first U.S. person to be certified by AOFI. We have two scholars on our Sharia advisory board, Dr. Muhammad Adam Sheikh and Dr. Yusuf al-Shubaili. And we did something even in addition. We were the first company that went and did a third-party compliance auditor for Sharia compliance. So we felt that it wasn't enough that we were doing all this internally. We wanted another company to come in and make sure that we were doing everything okay. And so they really audited us for the process that we use and make sure that everything is complying with these AOFI guidelines. And sometimes people ask us, well, who here is looking at you guys? And interestingly, it's actually the SEC. So whenever when we're audited by the SEC every few years, they come and they want to see that whatever you're telling investors, you're actually doing. So that's kind of interesting. Living here in America, actually these rules and principles really can help us, and it's wonderful that they're actually enforced. So at Azzad, we're really looking for halal screened investments. We're avoiding interest, and we're looking at companies that are high quality and have healthy balance sheets. So I mentioned before the advantages of mutual funds. What is the mutual fund? The mutual fund is basically a portfolio or a basket of stocks. The Azzad funds, we use again a halal investment process. So that way, all of the screening process is done for you. We also provide the purification calculator, so it's very simple for you to go online, enter the number of shares that you own, and know how much you need to purify. It helps you diversify. So when you invest, for example, in our stock mutual fund, you get about 70 companies in various different industries, and it has a professional manager. And you have liquidity. So when it comes time for your child to actually need the money or use the money, these are liquid, meaning that when you sell these shares, you can typically have the money, within 3 to 5 business days. So it's not like real estate where you have to put it on the market, wait to see if it sells. If it doesn't sell, this is a liquid market, so you can easily redeem your shares whenever you need. Now, we have two funds I'll just quickly share with you. One is the Azzad Wise Capital Fund. This is the first halal fixed income fund. So when I talked earlier about bonds and said that bonds are typically lending borrowing agreements with interest, this is a real challenge for us as American Muslims. We didn't have an alternative. What do you do when you don't want to invest in stocks, but you don't have a place to go for fixed income. You can't invest in bonds because you don't want to generate income from interest. So this fund was launched in 2010, and the primary investment objective was to provide shareholders with income and capital preservation. It invests in the Islamic halal alternatives for fixed income, which are sukuk and Islamic bank deposit programs. So the nice thing is this actually gives you an uncorrelated alternative investment. It's different from conventional bonds because it's investing in high-quality Islamic bank deposit programs and sukuk. And what sukuk are, these are financial certificates of ownership of an asset. So just to give you a background, bonds, like I said, they're a lending borrowing agreement. If you buy a bond from a company, you're actually lending them money. And they're promising to pay you back over a certain time period with a certain amount of interest. And at the end of the term, they're going to pay your money back. What a sukuk does, a sukuk instead is an ownership in an asset. So say that same company, and let's say GE, this is a real example. GE issued a sukuk where they wanted to buy engines. Now, they could have borrowed money by issuing a bond, but they wanted to do it in a halal way to, again, attract people who are looking for Islamic alternatives. When they issued a sukuk, what the sukuk does is when you buy a sukuk, you are actually buying ownership in the engines, and then you're leasing that to GE. So GE pays a lease payment to you as the engine, partial engine owner, let's say, and that's how you're receiving your income stream. So it's not based on a lending borrowing agreement. It's based on an actual asset that is generating income from lease. So you can see the means is different, but the end is the same. People say, oh, it looks the same. I'm getting income. At the end, you're paying me back. What's the difference? The difference here is that, again, there's an asset that is generating income. It's not a lending borrow agreement where just money is accruing by the mere passage of time. And again, that's one of the great things about Islamic finance is, again, achieving a very similar end, but through a halal means. And this is the portfolio manager. So at Azzad, we really believe that it's important to align with industry leaders and people who really have a strong background in these areas. So the Wise Capital Fund is sub-advised by Federated. This is a firm that manages about $245 billion. Interestingly, they were investing in sukuk and other types of halal investments for general funds that they invest for other large companies. And when we went to them and we said, look, we have a fund that only invests in halal, they were really excited. And they actually started being the sub-advisors of this fund. Now, the great thing is that, at Azzad, we focus on making sure that these investments are halal. And we utilize these partners really to make sure that there's strong resources. When they do the credit management for these banks, they're doing the same credit management that they do for the other $245 billion that they manage. So it's a lot of strong resources that, alhamdulillah, we've been able to bring in. The other fund that we have is the Azzad Ethical Fund. This is a growth-oriented fund, so this is a fund investing in stocks. We're investing in companies that have sustainable businesses with quality returns and healthy, strong balance sheets. And actually, the manager for this fund is Ziegler Lotsoff Capital Management here based in Chicago. So one last thing, in terms of educating on halal investing, there's a lot of information. Obviously, I couldn't go through it in the half hour or so that we had today. We do have more resources on our website to educate yourself at azzadfunds.com. For anyone who's attending here, I did bring some white papers on education savings that you're free, feel free to take with you. And also on our website, we have more white papers. If you want this one, you can pass those around. We have more white papers on our website, and we have more videos that you can watch on YouTube, again, on retirement, zakah, purification, estate planning. And so that way you can just start educating yourselves about your various options. So with that, I think we'll take some questions.